Indeed, after breaking above $1,700 per ounce, gold prices are now challenging levels not seen since 2012. Clearly, a major factor driving this move is gold's traditional role as a safe haven and hedge in systemic crises, such as the one that we are experiencing right now with COVID-19. However, it is interesting to note that independent of the immediate crisis, gold has continued to track very closely the major factor that determines its long-term level, which is real interest rates. Even the sharp intermittent correction that we saw in the middle of March is fully explained and was foreshadowed by a quick temporary drop of real interest rates as liquidation pressures caused nominal interest rates to shoot up and inflation expectations dropped rapidly in the wake of the collapse in energy prices. If, as we anticipate, the pandemic stretches into next year, we fully expect gold prices to reach new all-time highs, given the unprecedented level of monetary and fiscal support measures for the global economy. Now, one remaining obstacle clearly is the strength of the US dollar. However, the Federal Reserve is very hard at work through their large-scale asset purchase program, additional swap lines that have been opened up, as well as an international repo facility to bring the dollar down. At some point, as things calm down further, we believe that the very low level of US interest rates is going to help weaken the dollar internationally. Inflation expectations have dropped quite precipitously as well, especially as the deflationary demand shock has been exacerbated by rapidly declining energy prices. Now, the great thing about gold is that it tends to work both in deflationary as well as inflationary environments. However, given the extremely low level of interest rates that prevail now in the US with the policy rate at 0, we believe that somewhat higher inflation in terms of the real interest rate outlook would in fact be beneficial to higher gold prices, and that is an ingredient that is still missing in this context. Both options are attractive at this time. With mining stocks, however, one must keep in mind that in addition to indirect exposure to gold prices, direct exposure to company-specific risks are assumed. Thus, it's important to diversify exposure across a basket of names or by investing through an ETF. Furthermore, general systematic equity market risk plays a role as well, and both of those factors contribute to significantly higher volatility compared to a direct investment in gold. On the other hand, gold mining stocks remain very attractively valued. They're fundamentally cheap, and even after the recent breakout to the upside, they continue to trade at levels significantly below those that prevailed 10 years ago. If you'd like further information, please do not hesitate to get in touch with us through your sales contact.